Welcome to the video on the 12-month money trap, where we unpack why low risk is your highest reward when your goal is just around the corner. First, we will set the stage. If you are saving for a major purchase like a home down payment in roughly 10 to 12 months, your top priority is preserving your capital and keeping it accessible. Next, we will compare vehicles like high-yield savings accounts, money market funds, certificates of deposit, and Treasury bills. Then, we will explore CD laddering to balance higher rates with frequent access. Finally, we will close with key takeaways, a short quiz, and a practical plan you can implement today. Here is our agenda. First, we will frame the problem and define the short time horizon risk trap. Next, we will identify the safe default options, including high-yield savings accounts and conservative money market funds. Then, we will discuss the higher rate temptations, like certificates of deposit and short-term Treasury bills. After that, we will show how to use a CD ladder to maintain liquidity while improving yield. We will then walk through an implementation checklist, take a quick quiz to test understanding, and finish with key takeaways and a brief disclaimer. At a high level, the big idea is simple. When your purchase is near, liquidity is more valuable than a marginal increase in yield. First, your primary goal is capital safety. You need instant access and stability with no loss of principal. Next, there is a natural temptation to chase higher rates using certificates of deposit or Treasury bills. However, there are trade-offs, including early withdrawal penalties on CDs, potential price fluctuations if you must sell T-bills before maturity, and various tax nuances. Therefore, the best default is to use a high-yield savings account or a conservative money market fund. Finally, for those who want to optimize, a CD ladder or staggered short-term treasuries can provide a measured way to improve returns without sacrificing practical access. Let us start with the default champions for funds needed within a year: high-yield savings accounts and conservative money market funds. First, a high-yield savings account typically offers a competitive rate with daily liquidity and federal deposit insurance via FDIC or NCUA within coverage limits. Next, a conservative money market fund usually holds short-term Treasury bills, agency securities, and high-quality cash equivalents, offering stability and same-day or next-day liquidity depending on the platform. This pairing is ideal when your house closing date is uncertain because you can move funds quickly as needed. Importantly, there are no early withdrawal penalties and you avoid market timing risk entirely. Now let us compare two mindsets. On the left is the liquidity-first path, using high-yield savings accounts or money market funds. This path gives instant access for unexpected closing dates, avoids penalties and price risk, and simplifies management. On the right is the rate-chasing path, using certificates of deposit or Treasury bills. While this path may offer slightly higher headline yields, it comes with strings attached. Certificates of deposit may impose early withdrawal penalties that can erase gains if you need cash sooner. Treasury bills can often be sold in the secondary market, but if you must sell before maturity, the price may be below par depending on interest rate movements, introducing potential losses. Thus, the left side prioritizes certainty, while the right side adds complexity and risk in exchange for marginal yield. Next, let us examine certificates of deposit and Treasury bills in more detail. Certificates of deposit can offer higher yields, but most bank CDs impose early withdrawal penalties that may amount to multiple months of interest, which is a meaningful cost if you need access unexpectedly. Brokered CDs can sometimes be sold on a secondary market, yet their prices fluctuate with interest rates, so there is no guarantee you will receive full principal. Treasury bills offer a federal tax advantage and can be sold via a brokerage if necessary. But selling before maturity introduces price risk and potential friction from bid-ask spreads. Therefore, these tools are best when your timeline is firm, but they become less attractive when your dream home might appear earlier than planned. This decision flow starts by asking whether your goal is within 12 months. If not, broader options may be considered outside the scope of this video. If yes, we ask whether your closing date is uncertain. If it is uncertain, the default recommendation is to use a high-yield savings account or a conservative money market fund to preserve liquidity. For viewers seeking a small yield boost while maintaining rolling access, an optional path is to build a CD or Treasury bill ladder with staggered maturities. A clear warning is included to beware of early withdrawal penalties on CDs and price risk on securities sold before maturity. If your closing date is certain, then using a CD or Treasury bill that matures just before you need the money can be appropriate. Here is a practical ladder build. First, Divide your cash into 4 equal parts across 3, 6, 9, and 12-month terms. Second, when possible, use no penalty CDs. Otherwise, read the early withdrawal penalty disclosure carefully and calculate your worst-case cost. Third, stagger your purchase dates such that one position matures roughly every 3 months, creating frequent liquidity windows. Fourth, when a rung matures, either withdraw it to your checking account to prepare for closing or roll it to the back of the ladder if your timeline extends. Finally, keep a cushion in a high-yield savings account to cover emergencies and unexpected appraisals or closing adjustments. This table summarizes the main options. High-yield savings accounts provide instant, penalty-free access with competitive variable rates, though rates can change and bank transfer limits may apply. Conservative money market funds typically offer same-day or next-day liquidity and competitive yields that float with short-term interest rates. They are generally not FDIC insured and follow fund rules. Bank certificates of deposit are locked until maturity and often yield more than a savings account, but early withdrawal penalties reduce flexibility. Brokered CDs can be sold on the secondary market, introducing market price risk before maturity. Treasury bills up to 1 year offer competitive yields and favorable state tax treatment, but if sold early, their price can be below par and bid-ask spreads can reduce proceeds. Quiz time. The question is, you plan to buy a home in 8 to 10 months, but the exact closing date is uncertain. Which primary vehicle best fits this timeline? Option A is a broad stock index fund. Option B is a high-yield savings account or conservative money market fund. Option C is a 3-year corporate bond fund. Option D is a 5-year certificate of deposit with a top annual percentage yield. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Option B, a high-yield savings account or conservative money market fund. For horizons of 12 months or less with uncertain timing, liquidity and capital preservation are paramount. Stocks and longer-duration bond funds can experience drawdowns within a year. A 5-year certificate of deposit may impose significant penalties if you need to break it early. Here are practical tactics. First, keep an extra 1 to 2% of the target home price in your high-yield savings account to cover appraisals and inspection surprises. Second, use brokerage-based Treasury bills only if you are comfortable holding to maturity. Otherwise, you accept price risk. Third, avoid callable certificates of deposit and prefer no penalty CDs when available. Fourth, set calendar alerts for maturity dates and only enable auto-roll features if you are confident the closing will not happen during that window. Fifth, before it matters, test your transfer setup and understand ACH cutoff times and daily limits to avoid last-minute liquidity bottlenecks. This pie chart illustrates a sample allocation when timing is uncertain. Half of the funds sit in a high-yield savings account to maximize immediate access. A quarter is in a conservative money market fund for additional liquidity and diversification. 15% is in a small CD ladder to capture a modest yield bump with staggered maturities. The remaining 10% is in short Treasury bills with maturities not exceeding 6 months. This is illustrative only and not advice. Your allocation should reflect your risk tolerance, transfer logistics, and exact timeline. Here is a second quiz. In a CD ladder, which risk most directly affects your access if your home closes earlier than expected? Option A is credit risk of the issuing bank. Option B is early withdrawal penalties on CDs you must break. Option C is FDIC insurance limits. Option D is inflation risk over 3 months. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Option B. If your closing date arrives earlier than expected, you may need to break a certificate of deposit. Doing so typically triggers an early withdrawal penalty that can forfeit months of interest, undermining the yield advantage you sought and potentially reducing your realized return. These are the key points. For horizons under 12 months, safety and access are more important than yield. High-yield savings accounts and conservative money market funds are the default choices when the closing date is uncertain. Certificates of deposit and Treasury bills can be useful, but only if you account for early withdrawal penalties and price risk. Laddering instruments creates frequent liquidity windows. Above all, do not jeopardize your down payment for a marginal increase in annual percentage yield. To wrap up, First, decide the minimum liquidity window you must maintain for your situation. Next, pick a default home for your funds, either a high-yield savings account or a conservative money market fund. If you want to optimize, consider a small 3, 6, 9, and 12-month ladder. Then, set alerts, test transfers, and maintain a cash buffer. Finally, protect your down payment and avoid overreaching for yield. Before we end, an important disclaimer. This content is educational and is not financial, tax, or legal advice. Product terms, yields, and regulations change over time and by institution. Always read disclosures, verify current terms, and consult a qualified advisor who understands your circumstances before implementing any strategy. Thanks for watching. If this helped you avoid the 12-month money trap, please like the video, share it with someone saving for a home, and subscribe for more practical money guides. I would love to hear your short-term strategy in the comments. What mix are you using and why? Your insights can help the entire community.